Ticker symbol CPAY is up over 20% in the past year, and today we'll be looking at a company which has a great business model with growing revenues. However, could this be a troubled growth machine? Because in the past year its net income has contracted by 3%, and this is because despite them growing their revenues, their net margins are contracting quarter after quarter. But today we'll be seeing if that can be solved. So today we'll be looking at none other than Corpay, a payment solution company. In their annual report, they state that they're a global payments company that helps businesses and consumers better manage their expenses. They basically help customers manage expenses which can be related to vehicles, lodging, and corporate payments. The reason why this company exists is because they say that businesses lack the proper tools to monitor corporate expenses, and additionally, they currently employ manual processes that are not very efficient and result in wasted time, money, and even making errors, which can hurt the company over the long term. So what Corpay offers is a wide range of modern, digitalized solutions which provide not only control, but also reporting and automation benefits. I currently work at a big multinational firm, and I can say that this is a big pain, because with hundreds of thousands of employees, you can imagine how hard it must be to ensure that all employees are being compliant when it comes to actually reporting corporate expenses. For example, when I go on a corporate trip, I need to ensure that I'm booking the flights, the hotel, the proper amounts for dinner, lunch, breakfast, and the company has to ensure that all of this is actual business expenses and none of this is irresponsible expenses while using your corporate card. These corporate expenses can accrue to millions and hundreds of millions every single year, which means that there really is a pain in the world which Corpay is actually tackling. And they say that they have 3 main advantages and 3 main points of differentiation that allows them to provide a very valuable offering. Number 1 is that they say that most of their revenues derive from, first of all, business customers, which are corporations, and from recurring revenue models. And this is great because corporate customers are usually very predictable, have very high retention rates, and it's very difficult for them to not have consistent volumes. Number 2 is that they provide specialized technology platforms and even proprietary payment acceptance networks, which allows them to create barriers to entry, as they don't depend on any other third-party providers, having more control, more security, and, as they say, developing barriers to entry for other customers trying to enter this space. And number 3 is that they have very high EBITDA margins and a very high cash flow translation. This we can see in their financial analysis, as they currently have a return on capital employed of 19%, which is above our threshold of 15%. They have an interest coverage ratio of 5 times, which I'm not too happy about, as we usually look for companies with interest coverage ratios above the 10 times mark. Then, as they said, they have a very high cash conversion ratio, being over 90% and meaning that they're very good at transforming their net income into free cash flow. They follow up by having a gross margin above 78% and a net margin above 25%, which are very good figures as we usually look for companies with a net margin above 15%. Now it is true that this company has very solid predictable revenue growth, but we do have to say that this is slow. The revenues grew at a 6% year over year, and as we can see, their net margin has been contracting quarter after quarter, and their net income is actually suffering from this development. Surprisingly, however, we know that efficiency ratios usually follow the net income. However, in this case, we can see that return on invested capital, which is the metric we like to focus on, has been increasing quarter after quarter since December 2022, and it's currently closing in on 40%. And when we look at their balance sheet, we can see that both their assets and their total liabilities have been increasing at a very constant pace since 2020. However, their current ratio has been extremely stable. What does this mean? Well, it means that the gap that there is between their total assets and their total liabilities has been fairly similar for the past 5 years. However, when we look at their fundamental analysis, this company gets 4.5 ticks out of the possible 8. What do they have going for them? Well, first of all, they use a lot of their free cash flow in order to conduct share buyback programs and return a lot of their value to shareholders, and they're able to grow their free cash flow organically, which is mainly being funneled by their organic revenue growth. And as we always say, by organic, we basically mean that they don't rely on acquisitions in order to improve their top line. And when it comes to the 2 most important parts of this slide, which are pricing power and existing mode, I do believe that Corpay meets them both. When it comes to the pricing power, as we have seen, their main type of customer is corporates, and they have a very big chunk of the revenues which comes from recurring revenue sources. And this is great because it gives them a lot of predictability. But what's great about corporate consumers as well is that they're not very sensitive to price hikes in the softwares that they're already using, because corporations are a lot less sensitive to price changes than individuals. And additionally, once a company starts to work with one software, since they have all of their data uploaded on that software and they train their employees to understand and use that software, it becomes very tough for them to actually switch providers. Most of their clients are very big corporations. And when it comes to a company that probably has corporate payments which are over the $1 million mark, paying a couple $1,000s for a software is not a big deal. And if that software's price maybe increases by a 5% in a year, it will be no big deal for them, especially because by using this software, they're able to save a lot more in expenses than the amount that they're actually spending on the software itself. So this at the end of the day becomes a business case for saving money. And in most of these cases, due to the high retention rate and high customer satisfaction that Corpay actually has, we can see why a lot of these clients are not leaving Corpay despite the prices being increased at a rate above inflation for a very long time. And when it comes to the existing mode or competitive advantage, I had my doubts, because there are many new softwares and companies that are being developed in this space, which are now implementing new technologies, artificial intelligence, and other algorithms which improve the offering and the value that they generate to corporations. In this sense, these companies can slowly start to chip away at Corpay's market share and start to steal some clients from them. So it's essential that Corpay actually keeps themselves being innovative and delivering that premium quality that they offer to their clients. However, on the other side, I do believe they have an existing moat because they have developed such an ecosystem regarding the corporate payments that it's very hard for their clients to now migrate all of their information and all of their systems into a different provider. So what they have managed to do in order to develop this competitive advantage is to create high switching costs, which the client will have to incur if they decide to switch provider. This makes it a lot harder and more expensive for their clients to switch from Corpay to another provider, which is great for their existing moat. Now, there are a few things that I didn't like, starting with their low liability risk, where as we can see, they had a 5 times interest coverage ratio, and we usually like this value above 10. But also, despite their assets being above their total liabilities, they are not able to pay their short-term liabilities only by using their current assets. And when we look at their free cash flow generation, yes, this is growing, but it's not predictable and it's not consistent, to the point where if I had to predict their following cash flow on the following quarter, it would be extremely difficult for me to do so. And the last point is that they don't pay a dividend despite having very consistent revenues and net income. Having said that, we can see that this company is trading at the highest valuation it has traded at for the past 3 to 4 years, rising over a 24 price to earnings multiple. On the other hand, if we look at their 6.88% free cash flow yield, this is way higher than the long-term inflation rate, which suggests that this company may actually be trading at an undervalued valuation. Now, if we look at their risks and possible challenges, yes, the main one that I do see is the worsening competitive landscape, where there is a lot of new competition emerging in this sector, a lot of new, promising, innovative competitors and solutions that provide a lot more value to customers than what Corpay is currently offering. Now, I do trust that this company will step up and start to provide new offerings and more valuable solutions to their existing clients, but we will have to see how this develops. On the other hand, I also see the risk of economic downturn or cyclicality risks, where whenever there is an economic recession, companies start to crack down on expenses big time. And one of the easiest costs to start to track and actually attack are corporate expenses. So if the company starts to have a lot less corporate expenses, they will have less of a need to use softwares like Corpay, and this may directly affect their revenues. Having said that, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I do believe that this company has a strong competitive advantage, that they have a high return on capital employed, meaning that they know how to create value for the investor, but they do not have consistent nor predictable cash flows. So, despite me believing that this is a good company and may be a good investment, I believe that it lacks predictability and a solid growth strategy. Having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.